30 years ago to this day of June, there was one such company that came out with an IPO, June of 1993. Unfortunately, the IPO, that is the initial public offering of the company, bombed on the stock market. If you had bought 100 shares by paying 9,500 rupees at that point in time and held it on, you would have about, now there are valuable lessons for all of us to take home from this whole journey that Steve Jobs once said, "You can only connect the dots backwards, not forwards." Last week, I was thinking about the current crop of IPOs, especially those that are tech-enabled IPOs that are now underwater. They are significantly down from their issue prices. And I was thinking about them, and my thoughts led me 30 years back to one such company. And this is a nice story for all of us to understand. 30 years ago to this day of June, there was one such company that came out with an IPO, June of 1993. The company priced its shares at 95 rupees and the minimum offering was for 100 shares. So 9,500 rupees was the investment that ought to have been made. Unfortunately, the IPO, that is the initial public offering of the company, bombed on the stock market. There weren't enough people willing to subscribe to that company. Nobody liked that company. In fact, the company's issue almost devolved, except for the fact that Morgan Stanley stepped in and bought a lot of shares at that point in time. But cut to today, over the last 30 years, exactly 30 years, that particular company, an IT services company, has given 8 bonus issues and 1 stock split. Net result is that if you had bought 100 shares by paying 9,500 rupees at that point in time and held it on, you would have about lakh and 2,000 plus shares at this point in time. And if you had paid 9,500 at that point, and guess what the value of that 1,02,000 shares is as of today? It's 15.25 crores. Yes, my friends, I am referring to Infosys. The bellwether darling of Indian stock markets today was a company that wasn't well appreciated when it came out with an IPO. Nobody understood the business model of a company that didn't have any fixed asset, that didn't have machinery, that didn't have any of the usual things. Now, there are valuable lessons for all of us to take home from this whole journey that Infosys has taken. And that's what we're going to talk about. Learnings from the Infosys story is as follows. Stock market is a herd. Generally, these herds aren't very intelligent. They always look to a company with data that they have with them from the past. They don't necessarily look at the future all the time. So it's entirely possible that sometimes when we go with herd, we get the item wrong. We pick the wrong winners or we fail to pick the winner any one way. Second, it's always important to look at the vision and the execution of the company. Infosys had great founders with great vision and it executed its plan beautifully. It grew at a compounded rate of about 30-40% year on year. Now that's the kind of growth that anyone would be willing to pay for. So that's something that stock markets don't easily recognize early on. Last but not the least, before you invest, one needs to look at good governance. The business model itself, it may be a new business model, but is this the model of the future? Is this going to bring rich rewards? Is this scalable? These are questions that one needs to ask. And if you're convinced, some of those companies can give you big returns. So, what are you waiting for? Do a little homework, take a little risk. It could be those IT companies, IT-enabled businesses that came out about 6 months ago and could be in deep discount and deep distress at this point in time. Maybe, just maybe, 20 years down, you will be blessing yourself for having invested in some of those in times like these.